Hi, and welcome to the Macro Show, where we talk macro and try to make sense of markets. And look, there's no way, whether you're bullish or bearish, you can't make sense of today's markets no matter what you try to do. I'm your host, Steve Van Meter, and I bet some of you tuned in today to find out if I'd be huddled up in a corner crying and waving a white flag. And the answer is no, not even close. Today, we're going to answer the question, is a vaccine inflationary? Because that's what's on the minds of everyone. And I know we'll have to postpone our planned show for today to hopefully Wednesday. And I want to share with you, I want you to think about this a little bit, is did the pandemic cause the problem we're in? And the answer is no, it did not. And we have a dollar shortage. And when did the dollar shortage start? It started back in 2018. And when did the Fed first start cutting rates this cycle? Do you remember? It was the summer of 2019. When did they bring back quantitative easing? Do you remember? October of 2019. So the dollar shortage is what really kicked this off, and the pandemic only made it worse. So the notion that all of a sudden there's a vaccine and all of a sudden it fixes everything, does it fix the dollar shortage? No, it doesn't. Does it fix the holes in the monetary system that are causing so many of the problems we're seeing? No, it doesn't fix any of that. We'll look at some stuff today, but it's going to take a year, 2 plus potentially, to get through all of this. And there's a big dark storm coming in the matter of months. We'll get to that here shortly. But is the news today going to stop an employer, from closing a store or shuttling an unproductive business unit or closing down, a location that's just not productive? No, it's not going to change any of that. Businesses are going to look at their least profitable areas and they're going to get rid of them regardless. They're not, sitting around today going like, oh, hey, maybe there's a vaccine. So, instead of all those people we're going to lay off, let's just keep them around for a little while longer just in case. Not going to happen. Businesses are still going to continue forth with their plans. And will all these people losing their jobs get them back? No. I mean, we already know, just due to the amount of government debt, if you take a chart and invert it against the labor force participation rate, all these jobs are coming back. And I don't mean to say that to be mean. It's just a matter of truth. My dry cleaner happens to be one of my neighbors. He had 4 locations. He and I think his brother or his partner had 4 locations. Now they have 3. And I asked him about a month ago, hey, are you going to reopen your closed store when things return to normal? He says, no, we're never going to go back to 4 stores. We're going to stay at 3. And he said, even though it's going to mean a little bit less business, the amount of money we're saving by not having that store is huge. So no, we're never going to go back to that. Those are permanent job losses. That location that he was renting is now vacant. And a lot of businesses are going to look at it. I mean, imagine if you own like 8 different restaurants, right? Maybe you're a chain. In the past, you could see that, as you open a new restaurant, some of your strong stores support your lost stores until they get stronger. Now restaurant owners are going to say, you know what? We're going to have to close some of those locations because they can't stand on their own 2 feet. This is going to happen across every industry. It's not going to change tonight because there's a potential vaccine out there. And is there pent-up demand? People just can't wait. They're just dying to get out and spend. The psychology of this is a whole lot different. Back in March, when we went, and through May, when we went into the lockdown, what was the belief? The belief was this was temporary. We're going home for a couple months. The government sent us a bunch of money. And then we saw all this pent-up demand. But when you're on unemployment for 6, 9, 12 plus months, I don't even know if it goes beyond 12 months. I don't think it does. But when you're out of work that long, do you know what changes? Your spending habits. You no longer think, man, as soon as I get a job, I'm going to run out and spend all my money. No, it changes the way you think. It changes the way you spend because you don't know when you go back to work how long that's going to last. You still got to remember, you've got to rebuild your savings. You've got to catch up on your bills. You've got a lot of things to take care of. So the longer this persists, the less pent-up demand there is. That is also a problem. Now, what does a vaccine potentially give us? A path back to normalcy. That's what it does. It finally says that, hey, perhaps in a year or 2, we do have a path to getting back to normal if we can't get this thing under control. Now, let's go look at the news today and see what actually happened. And what we saw was Pfizer and BioNTech said COVID vaccine is more than 90% effective. Great day for science and humanity. Now let's dig deep into here and find out what it says. It says their coronavirus vaccine was more than 90% effective in preventing, keyword preventing. Understand, a vaccine is not a cure. COVID-19 among those without evidence of prior infection. So that means you cannot have prior infection for that to work so far. And let's keep looking down here and see what we find. And Pfizer's results were based on the first interim efficacy analysis conducted by an external and independent data monitoring committee from phase 3 clinical study. So there's still more research to do. The analysis evaluated 94 confirmed COVID-19 infections among the trial's 43,538 participants. So that is a pretty good number. If it is at 90% at 7 days after, second dose. Didn't hear that in the news when the markets were reacting the way they did. It means that protection from COVID-19 is achieved 28 days after the initial vaccination, which consists of a 2-dose schedule. Final vaccine may vary. The percentage may vary. Now, another thing that is not mentioned here is you may have heard that there are cases that people who have gotten COVID and become cured of it, 90 days later, 25% of them lose all their antibodies. So we don't even know if this is a temporary vaccine. It will last 90 days, 6 months, a year. We don't know. We don't know that yet. And that's a problem. It tells us we're not through this yet. Let's keep digging around in here. And it says it would not be widely available until the third quarter of 2021. Now, President-elect Joe Biden says, hey, we're about to enter COVID hell. And he is absolutely right that bad things are about to come, because we are seeing cases over 100,000 a day. That is a huge problem. And those numbers are growing, and we're not even into the winter months. We're now just into fall. And he says what Michael Osterholm, who is now the newly appointed coronavirus advisor of the president-elect, said we're about to enter COVID hell because of all these case surges. And this is, here we are, 108,736. This is a problem that's going to get worse by Thanksgiving and Christmas. And you have to then think, are all these 20-some million people, well, I think it was around, 22 million people? Man, are they going to go out and put a bunch of pent-up demand into the holiday season when they're unemployed and not sure when the next COVID relief bill will come, which many think is coming this year? It's not. We have a lame duck Senate right now. We have 2 senators that aren't there because they got to rerun the election, and that's not till January. Yeah, I don't know. Everyone thinks that, there's just be all this stimulus, all this stuff. Not going to happen the way everyone thinks. So do you think people are going to rush out and spend money that they don't know they have? Probably not. Let's keep digging into this. And he said Osterholm warned that the U.S. would see an astronomical increase in new cases. That prediction has come true only in a matter of weeks, and this number is going to continue to increase substantially. So think about that. If there is a rise in cases and you are a business owner or you're a consumer, is that going to motivate you to get on an airplane and travel for the holidays or do a lot of stuff? No, it's going to scare people into staying home. Even people that aren't afraid, when the numbers keep rising, they will. So let's see. We're not come close to the peak, and our hospitals are now being overrun. I have confirmation from 2 ER doctors today that this is happening. And the next 3 to 4 months are going to be by far the darkest. That is correct. There is going to get worse. And he says it's clear this vaccine, even if approved, so there's some uncertainty here, will not be widely available for many months to come. Biden said the challenge before us right now is still immense and growing. And now this is a post from Raoul Pal of Global Macro Investor. He posted this on Twitter today, and his firm has been tracking the cases and the deaths, because you've been hearing that, there's not a lot of deaths, so it's not really a big deal. People are just getting infected and clogging up the hospital system. Well, he shows here the COVID-19 confirmed cases 7-day rolling total, U.S., United States leading 17 days, and then you can see the COVID-19 deaths, 7-day rolling total, and you can see the relationship going back to July. What that suggests is if the Biden administration's team or the COVID task force team's correct, we're going to see a surge in cases, which is going to also see a surge in deaths. That is not going to give employers the warm and fuzzy feeling to keep people around. It's not going to give consumers the warm and fuzzy to go out and flood the malls and go out and buy a bunch of stuff for the holidays and travel and do all that stuff. Those next 3 to 4 months are going to be devastating for the economy if these numbers keep rising. And that is not inflationary at all. Nowhere even close. Now, some of you are wondering, are we going to talk about bonds at some point? Of course. We're going to talk about bonds because, yes, the kingdom is under siege. This is a special edition of the macro show. Why wouldn't it be? When the kingdom's under siege, it's always under siege until it's not, until everyone wants to be there. Here is today's 3-year Treasury auction. And this was by all means a terrible auction as auctions go because foreign bidders backed off massively from this auction. They took a very small percentage, but yet the dealers, the primary dealers, bid so heavily that the market didn't even react to this. And normally you see a reaction. If you see a report like this that says, wow, primary dealers only took 21 billion, and normally they're taking like around 27, 28 billion, all of a sudden the market would have a negative reaction to this report, and it didn't even blip about it, which is pretty interesting because we're not done with this theme yet. You know, I've been talking about how lending standards are going to lead to a massive crash in asset prices, and they're getting tighter and tighter and tighter. And today, the senior loan officer survey for the last quarter just came out, hot off the presses. Let's take a look at that and see what's going on there. And we find out regarding loans to businesses, respondents to the October survey indicated on balance, they tighten their standards and terms on commercial and industrial loans to firms of all sizes. They also reported weaker demand, shocking for commercial industrial loans from firms of all sizes. Meanwhile, banks tightened standards and reported weaker demand across all 3 major commercial real estate loan categories: construction, land development loans, non-farm residential, and multifamily loans in the third quarter. For loans to households, banks tightened standards across all categories. You'll notice you're hearing all tightened. Not good words if you're looking for easy lending standards of residential real estate loans across all 3 consumer loan categories: credit card, auto, and consumer loans in the third quarter. Banks reported stronger demand, though, for all 3 categories in the consumer space. Now, isn't that interesting that consumers want money? As I mentioned, we're in a dollar shortage. Consumers want to borrow money. They just can't. Now, fortunately, there is a chart pack, but there's something odd about it, and I think whoever charted this got it wrong, and I will show you why. Because it shows there's a decrease in the net response to tightening standards, and yet the report said there was an increase. And so that's a July survey. So something's wrong because everywhere I look, you see demand down and lending standards down, even for, I'll show you, residential real estate. It says, wow, that they've really dropped. That isn't actually the case. So I pulled it up on the Fred database, which did update as well. And here is all commercial industrial loans. And you can see, bam, now second highest in the history of this report. And that means things are super, super tight. And as they get tighter, credit conditions contract, and that leads to lower interest rates. And here is all the major ones that I pulled together, and you can see they're tightening there. And I'll zoom in a bit. We got to zoom out to zoom in. So here we'll go to the 10-year, or let's go to the 5-year scale. And you can see very clearly that whatever that PDF, whoever did that PDF, I think maybe did something wrong because every one of these is tighter. And that's telling you the banks don't want to lend. And we'll zoom back out just so you can see the whole picture. The banks not only do not want to lend, they have no motivation to lend. You know, and you have to think about this from their perspective. Do you want to lend out money when there's 20-some million people on unemployment during a pandemic? you're not going to get your money back. And that's exactly what the banks think. But I do think, though, based on today's auction data from the 3-year, that it probably suggests that there is a greater probability that we will see an increase in the Fed purchases in the months that come. Now, the primary dealers wouldn't be bidding on this if they didn't think someone else was going to buy it from them. And when do people like to buy things in the market? They like to buy at highs. How do we know? Because people love buying stocks at the high. They do that all the time. And guess what? Well, they're going to end up buying bonds at the high, even though some are, I'll never buy bonds at the high. Yeah, well, when the kingdom comes calling for you and the drawbridge goes down, you will readily want to be a part of the bond kingdom, and you will be a buyer. All right, so if you look at the bond market, all the bad news is baked in now, right? We just got the last bit of news that the bond market could ever ask to be thrown at it was a vaccine. That was it. I mean, there isn't likely going to be a cure because we marginally have a vaccine. So there you go. It's the last of all of the bad news is there. Credit is still contracting. The banks are still tightening lending standards. There's still a huge short, maybe even a bigger short position as of today. I was going to look at all of that, but in the light of this new, overnight report, I thought we would talk about that another day. The Fed's still doing QE. That hasn't changed. The dealers are still buying. We saw that. There's still 22 million people on unemployment. And another thing that people don't understand the bond market is all the government debt acts like a ceiling to how high rates can go. And we keep seeing it over and over and over again. We'll look at the charts. And of course, now people are saying we're going to have rate hikes. Right. Because there's going to be all this inflation. Yeah, no. Let's take a look at the charts and just things that don't make sense is you have this big gap up overnight and rally, and look at that all in toward the closing end of the market. This kind of drop off. That's not normal. I mean, this is not what you expect to see, and if the market's going to take off. Look at the NASDAQ actually closed lower. You can kind of guess what direction stocks are going to head tomorrow. And look at the Dow, even it had that weird candlestick, moved way down. Russell 2000. Can't beat small caps, I guess. They're all over the place. How about Treasury yields? Well, we can zoom out for the last year, and we can see that once again, thou shall not get much higher than where they're at now. They just can't get much higher than here. Every time it gets around this, 1.6 to, high one, mid-ish 1.7s, the buyers are there. And sure enough, if we go and look at the TLT, we see they did not get back to their June lows, did not get back to their March lows. It's still all in play. And you look at the kind of the move at the end of the market, and you see this massive amount of trading volume. It bottomed out and up it went. It just goes to show that, if you look at sentiment, this little small tan line down here, and this is not the best sentiment chart in the history of the market, but it tells you interest in bonds are about as bad as it can be. And when things are as bad as they can be and you've got all the news baked in, well, you tend to get bottoms. So somewhere in here, maybe today, is the bottom. How about the dollar? Well, remember, dollar down. Some of you sent me messages, last week. Look at that. Boom, dollar bouncing up. Again, I told you it's in its trading range. It's still absolutely in play here. And as someone, a big fan of the show, messaged me and said, look, if you look back at that 2018 move, I said, yeah, I have. In fact, it looks really similar, and we've looked at it on the show, and you can see that I said based on this move here, you could see the dollar gonna get retouched the bottom of its recent trading range. There it did. Now the question is, will the dollar continue to move out from here and up away? It seems, like I said, strange day. Stocks still closed higher, bonds lower. Gold was lower too. Big move down in gold after late last week. Everyone said, we're on that big breakout. Again, this is kind of why technical analysis doesn't answer all the questions you might have. But we'll wrap the show up here. Be sure to like. You can tell me how big of an idiot I am in the comments. Subscribe, because that's cool. And we have little stick things that are fun to play with. Anyways, I'm your host, Steve Van Meter. Thanks for joining me today, and maybe we'll get to the topic, how hedge funds are positioned, and that Jeff Snyder report I wanted to look at on Wednesday, unless something more interesting comes along the way. But until then, we remain under siege, but we will win, because we all know how this ends. Thanks for watching. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It's not to be construed as a recommendation or solicitation to buy or sell a security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steve Van Meter on personal capacity. Opinions expressed in this video that moment do not affect the view of Atlas Financial Advisors Inc. or Steve Van Meter Financial.